The National Statistical Office is going to come out with the April-June quarter gross domestic product data on the 31st of August. But before the official numbers are made public, several projections have come out. The Finance Ministry estimates that the economy grew by around 15.6% in that quarter. This is lower than the Reserve Bank of India's Q1 FY23 projection. The RBI projects FY23 GDP growth at 7.2%, with Q1 forecast at 16.2%, Q2 at 6.2%, Q3 at 4.1%, and Q4 at 4%. Most economists also believe that the economy grew at a slower pace than the RBI MPC's projection for the first quarter. Their projections range between 12.5% and 17.8%. Double-digit GDP growth in Q1 FY23 over the 20.1% growth clocked in Q1 FY22 may appear to be quite high, but that quarter was affected by the second COVID-19 wave. In fact, the economy shrank by 8.5% in Q1 FY22 when compared with the corresponding pre-COVID period of FY20.
If you compare what these estimates are really saying about where the economy is relative to 1920, then whether you're taking 16% or 13% makes very little difference. What you are saying is that the economy in the first quarter of the current fiscal year will be only a little bit. So the average growth rate from 1920 to now would be somewhere in the range of 0.8 to 1.2% over a 3-year period. Okay, so we continue to be virtually where we were in 1920.
Citing a senior official, the Business Standard report on Finance Ministry estimates said that GDP components like private final consumption expenditure, gross fixed capital formation, and government final consumption expenditure showed healthy improvement. But the trade component was likely affected by high commodity prices and rupee depreciation. While private sector capex has started crowding back in and private consumption has improved despite inflationary pressures, trade has been affected by geopolitical headwinds. On a related note, with exports growing at a much slower pace compared to imports, the country's trade deficit widened to a record $30 billion in July. In fact, merchandise exports fell to a 5-month low of $36.27 billion in the same month.
On the external front, I think we should not hold too much hopes, not for the next year, year and a half. But on the positive side, just about the time when the external side is going down, the domestic side is starting to pick up. Now, the real question is, which of these two contradictory movements moves faster? If the external economy tanks very quickly, then we may see a serious reduction in our growth rate. And that already seems to be happening. If the domestic economy recovers with greater strength than we are currently assuming, then that may be taken care of and we may still be okay.
Manufacturing, construction, mining, and agriculture, which are the sectors that make up gross value added, are also expected to show healthy growth. Even touch services like tourism, hospitality, and leisure have bounced back from the effects of the pandemic due to pent-up demand. In FY22, all sectors except trade, hotels, and communication services were above the pre-pandemic levels of FY20. During its latest rate action in early August, the Reserve Bank of India's Monetary Policy Committee retained the real GDP growth forecast of 7.2% for the current financial year. Given the changing external and internal picture, there might be a doubt about whether this forecast can be retained going forward. So, what factors will determine the final print for the current financial year?
Now, there would tend to be a downward trajectory for the growth rates across the quarters. And in this particular year, while we are looking at a number of 7.2%, we should remember that it may not be reflective of the buoyancy in the economy, which to my mind is still very much limited to certain sectors. We should remember that the next 3 quarters are going to hold a clue to this number of 7.2%. The reason why we say the next few quarters are important is that as we come into the festival season and harvest season, which is going to start from the month of October or maybe late September onwards, We need to see whether this consumption pattern is maintained or not. The pent-up demand has kept the economy ticking to a very large extent and has not really been bothered by inflation, which has gotten reflected in lower financial savings. On the whole, I think it's going to be a wait and watch as to how consumption plays out in the next few quarters.
We are back where we stood right before the pandemic hit. The negative effects of the pandemic will continue to play out for years to come, especially for the most vulnerable sections. While India remains one of the fastest growing major economies, it remains to be seen if and when it will hit the sort of economic trajectory required to both heal these scars and meet the considerable challenges that predate COVID.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.